This year has been good for companies that are raising money through IPOs. Investors are also getting good returns. However, a few IPOs in the past few years have flopped, and this has raised a few questions. So, should retail investors ride the current wave of IPOs? If you want to invest, what should you keep in mind? What are the risks of IPO market? Let's understand that in this video. Most of the IPOs listed this year have been at a premium, and they have given positive returns to shareholders. This year, 34 IPOs have been listed on the main board so far. Now, out of these 34, 3 have returned more than 100%, 4 have given between 50 and 100%, 20 have given returns of between 10 and 50%, and negative returns have been seen in 3 IPOs. Now, let's talk about what to look for before investing and what to pay special attention to. First, check the company's financial condition. Analyze the company's financial statements from the previous years. How much revenue was generated? How much profit was made? Is the company consistently profitable or not? How much debt does the company have? All this information can be found in the draft red herring prospectus, that is DRHP, submitted by the company to SEBI for the IPO approval. Now, in the DRHP, if you look closely, the company also discloses its weaknesses, like for example, if there are any disputes or legal cases related to it. Keep in mind that in the case of financial results, you should look at figures for at least the past 5 years. Don't just rely solely on the financial figures of the past 2 or 3 years, because companies often try to improve their numbers in the run-up to an IPO. Now, additionally, it's essential to assess the company's promoters and the management team. Why is that? Because these individuals are responsible for critical decisions in the company. Strong, trustworthy and experienced promoters will lead the company to progress, and you will also receive good returns because of that. Now, similarly, you should also look at the valuation of the company shares. If the company seems overvalued, it's better to stay away from it. Now, how do you check this? Very simple. To check this, see at what price other similar companies were listed. And furthermore, it's crucial to understand whether the promoters are selling their existing shares in the IPO, meaning it's an offer for sale, or if new shares are being issued. Now, investing in IPOs that issue new shares is more preferable. Gather this information from the IPO prospectus. Whether the IPO funds will be used for expansion, or to pay off companies' debts, or to buy shares from founders or investors. If a significant portion of this amount is being used by the company to repay its debt or to buy shares from founders or investors, it's advisable to avoid investing in them. When investing in an IPO, it's also essential to consider the current state of the stock market, because if the market is bullish, the listing may happen with a momentum. If the market is experiencing continuous declines, the IPO could open with a cautionary sign. Speaking on this, stock market expert Ravi Singh advises that when investing in an IPO, investors should gather in-depth information about the company, its competitors, financial condition, significant cases or disputes, and the overall industry health, that is, the sector related to the company. So, in summary, it can be said that IPOs provide an opportunity for ordinary investors to make good money in the stock market. If investors like you exercise caution and conduct thorough research at the same time before investing, then you can avoid losses.